Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Alex, thanks for taking some time to join me on the show, mate.
Thanks, Owen. Great to be here. Looking forward to it.
Yeah, it's been a long time coming. I'm glad we can have this chat. We're going to answer some questions. We're going to learn a bit more about you and about Everest. And hopefully we'll have you back regularly to answer a lot of questions, because a lot of our community is, I guess, in the accumulation bucket. What we call an accumulation is like pre-retirement, and people are trying to solve a lot of problems, whether it's insurance, super, saving for a house, upgrading property, starting a business, getting out of a business, so many different things, having kids, and you and your team are so well placed to answer all these questions. So we will have a heap of questions at the back that folks have sent in. And please, there is a link in every episode on a Rask podcast where you can submit a question. Just select the Australian Finance Podcast or wherever you get your podcasts, property podcast, whatever, just submit your question. But mate, can you tell us, you're a financial planner today, but can you tell us, how did you get started in finance? Like, why was this interesting to you as a kid? Was it not? Let's go from there.
Right. How did I get started in finance? How long have we got? Yeah, I guess, I was probably somewhat born into it a little bit in that my old man was an accountant and owned his own accounting practice for 40 odd years, I think, before he sort of sold it. So sort of grew up, obviously, seeing a little bit of what he did and, being around that, I think through sort of osmosis, sort of absorbed, a few sort of money fundamentals and stuff like that. I also probably just found in general, just in general life, that I've always kind of got money to a degree. I've always probably been a relatively good saver. Do like to spend, don't get me wrong, but always found that saving money wasn't too hard necessarily. So it's probably, again, pretty just naturally lucky there in that sort of perspective.
Mm-hmm.
And then, into high school was just, very interested in economics. That was like my favorite sort of subject and one of the subjects that I sort of excelled at. And again, I guess just through probably osmosis through dad and stuff like that, was pretty good at accounting as well. So when I left school, actually, originally I was going to study dentistry. My uncle was a dentist, so didn't quite get the grades out of high school to get into that. So I ended up going into sciences. So did that for a year. Managed to get the grades then to potentially get into dentistry, but then just basically completely changed my mind in terms of what I wanted to do, and decided that actually I am generally interested in economics and commerce and how financial markets work and stuff like that. So ended up then switching over after that year to a double degree in commerce and economics, completed that, and then thought I would sort of, again, from WA, so I thought I'd jump into sort of like maybe one of the more sort of the mining industry and, doing something on the sort of management accounting side or something like that. Sort of gave that a go for a little bit, wasn't really into it necessarily, and then was kind of just fluffing around. And then, dad was basically tapped me on the shoulder, was like, look, why don't you just come try accounting, come work for us for a bit. So went and did that, ended up working there for, I think it was about 3 years as a tax accountant. Learned a lot, but again, wasn't super passionate necessarily about it. So I was sort of thinking about my next move. And that was sort of a time where a lot of accounting practices were starting financial planning. And basically they sort of tapped me on the shoulder and said, look, we're thinking of doing a JV with a more experienced financial planner, but we'd like someone younger to sort of come in from our end. Like, would you sort of be interested? And that was sort of when I was like, oh, that sounds interesting. I'll give that a go. And 10 years later, the rest is history, I guess.
What is it about financial planning that you find so interesting? Like what's made it stick?
Well, where to me personally, it's so much more interesting than accounting. No disrespect to all the accountants out there, is it's always forward looking. Whereas like tax accounting, which I was predominantly doing, is always like, what have you done? Let's look at the past year and stuff like that. Whereas financial planning is more about, what are you looking to do in the future? And then that problem solving piece. So I really enjoy that. The way I sort of describe it to clients is we help them sort of put the jigsaw together. So they come to us with the jigsaw pieces. So they want to buy their first house or upgrade their house, or they want to be able to retire early, or they want to plan for kids, or any of those sorts of, sort of things that are important to them. And then we help them sort of put those jigsaw pieces together to sort of complete the puzzle. And that, personally, I find, very interesting and very passionate about.
So people that are a bit sharp-eyed, Alex, they might have noticed that now we've formed a partnership together where people can get financial planning advice through Everest and come through us, and we can trust you to take care of people. But for anyone that hasn't been through that process, not just with us, but just in general, the financial planning process, can you describe what it looks like? Like, I'm imagining someone listening to this right now, they've heard our podcast for years, and for what it's worth, like, we've deliberately not had that many financial planners on the show over the years because it's so hard to know who to trust and whatever. But for folks that are now thinking, well, maybe now is the time that I get a second opinion, or my partner and I, we go and see you guys or whoever. Can you describe that process from end to end? So what does it look like from the beginning of, like, how should someone interact with a financial planner? How does that typically go right through to, the other side?
Yeah, so I'll explain our process sort of in a nutshell, but I think most financial planners would follow something similar. I would think it might just be a shorter version or potentially longer. I mean, from anecdotally speaking to other practices and stuff like that, like, our onboarding process is probably typically longer than most. But the reason we do that is, predominantly we are working with accumulators, so it's their first time meeting a financial planner. So we really want to make sure they do fully understand the process and are sort of comfortable before they sort of commit. So basically how it works with us is we take a 15-minute free phone call with the client. This is just to get to know a little bit more about their situation, us to sort of answer any initial questions, and basically make sure we're going to be potentially the right fit for each other. So effectively us sort of vetting that we can sort of provide some value to their situation. If we think we can, we then would move to what we call our initial meeting. This typically goes for around an hour with us. We don't charge for this either. And this is more for an opportunity for us to sort of take them through, okay, these are the key areas where we think we can sort of potentially help you. This is broadly how we help clients in those areas. This is the process from start to finish. So they understand how many meetings we would have, what's involved on their side, what's involved on our side. We explain how we charge, and we explain the fees. So the idea is at sort of the end of that hour, they've got all the information in front of them, so then they can make an educated decision of, yep, this sounds like the right thing for us, or, thanks for your time, but no thanks, which is obviously perfectly fine as well.
It's interesting because a lot of financial planning practices that I know wouldn't offer a full hour. It'd be like, well, 15 minutes, and then kind of like, you're not 15 minutes per se, maybe it's half an hour, whatever, but maybe they're like, you're in or you're out kind of thing, because it's obviously time for you guys and your team to put in to meeting with someone to then like watch them walk away. But I guess it makes sense. Sorry, go on.
Yeah, I was going to say, well, the reason we do it, right, because it's a good point, like, it is a large time investment for us. The reason that we do it, in all honesty, is because at the end of that hour, not always, but most people then want to proceed. And the reason we take that full, sort of, say, hour and a half in that meeting, plus sort of the phone call before, is that's kind of the time I think that is required to explain all the facets of how the whole thing works, because it's a bit of money. I'm not going to lie and stuff like that as well. So it's not cheap to seek financial advice. Okay, but so therefore you need to understand, okay, well, why does it sort of cost what it costs? And that's a lot of that explanation of going, oh, okay, well, if I agree to go ahead after this, we do have 2 strategy meetings, and then we do have a final meeting, and then they help me implement all the advice and stuff like that as well. Like, typically the process takes 6 to 8 weeks for us to sort of do, and it's quite intensive. So it is a fair bit of our time to get it done for the client. And again, it's highly personalized advice. It's not cookie cutter or anything like that as well. So it's a lot of investment in our expertise, but also just that client facing time as well throughout the process.
Yeah, for sure. Okay, so someone gets through, they've done this meeting. Is this, I imagine, what you would do maybe a fact find and you'd find out information about their client, or not yet?
So we will. So again, this is us speaking, obviously, just Everest specifically. So what we do is, we will take down, again, pretty like broadish information. And what I mean by that is it'll be like, okay, well, what's your mortgage? Oh, I think it's around 500,000. Okay, that'll all be fine for that initial meeting. If they agree to go ahead, then we will do a very accurate fact find, i.e., give us the loan statement so we know it's $501,202.03 kind of thing. But it's only once they sort of commit past that initial meeting that we get the specific information, including doing the research on their existing super funds, shareholdings if they've got them, mortgage if they've got that, all those sorts of things.
Yeah, cool. And so you pull together all this information, you do a risk profile, I'm guessing.
Yep.
Which is, I'm guessing, like a questionnaire that you maybe send to people.
Yep.
That comes out with like a profile for either a single or a couple, like individually. And then your team basically starts implementing, not implementing, but like.
So we would get all the information together, including like the goals that we've taken down from chatting to them. They also fill out a goals questionnaire as well. So we sort of collate the two of those, and then we go into our first strategy meeting. Now, in that strategy meeting, we would have already crunched the data that they've got and come up with a few pathways or a few potential solutions to basically meet those goals. And then we sit down and have that strategy meeting, which generally goes for about an hour and a half. Now, sometimes during that meeting, the pathways that we've gone down get rendered useless because they've decided X, Y, Z, or a lot of the time when they see what it actually looks like in terms of how it's cash flowed and forecast out and stuff like that, they're like, oh, that looks a little bit different to what I expected. Maybe we won't do that, or we'll do something slightly different, which is why with a couple, typically we'll have another strategy meeting before we move to finalization, because we need to sort of re-clean things up and stuff like that as well. It really, in all honesty, and we tell the clients in the initial meeting that you'll get one strategy meeting or you'll get two. It'll really just depend on what happens in that strategy meeting. Because if we go through it and you're like, yep, love that, and let's just tweak this slightly. Okay, perfect. Then we can obviously move to finalization.
How much does it cost to get advice for you guys? I know the industry can vary, like from like, 5,000, 10,000, sometimes 15, 20,000 for really complex retirees with high net worths and that sort of stuff. But like for you guys, because you mentioned bread and butter, not always, but I imagine most of the time is accumulators, people that are working, people that run their own business, sole traders, these types of things. Just broadly speaking, I know everyone will be different. Like, what does it cost?
Yeah, so like you said, everyone will be quite different. And I think if you are, chatting to a few financial planners and stuff like that, it's a good idea to get an idea of the process and what's involved and what you get and stuff like that too. Us, for example, our minimum is $4,000 is typically what we'll charge as a one-off fee to provide the advice and then help you implement it. Our fees range up to sort of 15,000, but we don't typically ever I've actually never charged that, to be honest. Most of our clients sort of sit between the 4 to 6.5 range generally as a one-off to provide the advice and then implement that all and get it in place.
Do they have to pay all of that up front? Like, how does that work?
So we've actually only recently changed this slightly, but we used to take it all at the end, which I told some other people in financial planning, and they almost fell off their chairs. So we have changed it slightly. I only actually, in 5 and a bit years of business, I think I've only been burnt 5 times, so once a year on average. So again, this is just specific to us. We generally take $1,000 as a deposit up front of that, and then the balance is payable at the end. Potentially some of that can be paid via super as well, depending if we are doing some work for the client's super fund or not too.
So without getting too far into the weeds, can you just explain a little bit? So some of it may be like, are we talking, because I'm just thinking like people's out-of-pocket expense if they're listening to this and they want to get financial advice, which so many of the community do. In fact, I think it's over 10% of our community want financial advice right now. So like if like, are we talking like a couple $100 is out of super? Like if they're getting full super advice, or is it 1,000? Like roughly speaking, everyone's different.
Yeah, so again, it really depends on the super balances and again, another sort of factors in terms of, because for example, we may do the research on the super fund and it may be appropriate, or for some reason they may really, really want to stay with that fund. Like they may have some sort of, I don't know, blind loyalty to Australian super for some reason. So then we'll just work within that fund as an example. Of which, you can pay a fee through to an advisor. But because some funds won't allow it. Most will, okay. But yeah, generally speaking, we take the 1,000 from cash flow, and the rest, depending on the situation, can be paid for via super.
Interesting. So that like brings down the barriers for a lot of people that want financial advice to set them up for the future.
Yeah, and the other advantage of putting it through super per se is it will get a 15% tax deduction within the fund.
Yeah. So that's great news for a lot of people that want to go through the process. And they might be saving for a house, or they might be have kids or a single income family. Then they're worried about their cash flow right now. So that kind of news is like really reassuring. I didn't know it was that high, by the way. But yeah,
cool. Again, it depends on a number of sort of factors per se, but generally that could be how it goes. Which, as you said, so for predominantly sort of the clients that we're working with, which is accumulators and stuff like that, they don't have hundreds of thousands of dollars sitting around in cash, but they want the advice. So potentially they're happy to pay some of it from cash flow and then the rest from their super fund.
I did send you a very short, hopefully we can do a very short kind of imagination exercise here of like, imagine you have a couple in their 30s or 40s or younger or older, whatever. And what are the most common problem areas that you would see if someone, you don't have to use a couple, you could just say generally speaking, like could be single, whatever. What are the kind of common problem areas that you see?
So if I can broadly put our clients into sort of 3 buckets, it'll generally be, say, a professional single or couple sort of pre-kids, okay? So and may not be having kids necessarily either. So just, have been in their professional jobs for a couple of years now, built up a bit of money, and that problem area is normally around buying their first home, okay? Or, wanting to invest some money but not quite sure how to necessarily do that, okay? Then we might have, fast forward, say 5 years later, it's the couple that are pregnant or want to get pregnant in the next 12 months and are a little bit concerned around their cash flows in terms of once we go down to 1 income or 1.5 incomes, what does that look like, say for our current mortgage repayments per se, or our current investing strategy, or our holidays or something like that. Basically, they want some help or some guidance around that. And then the other one would be, say, a couple or singles per se with young kids, and then it's around potentially again upgrading the house or investing for the kids, possibly getting on top of that cash flow, because now they've got kids and they're even more time poor than they were before, so they just want again more structure to how money flows and stuff like that, so they don't have to think about it too much. And I would guess overarching sort of all 3 of them common problems is normally just direction. So I spoke to a lady on the phone the other day, and she was like, "Oh, I'm not quite sure if it's for me because I'm not quite sure what I want to do." And I was like, to be honest, that's most people who we talk to. And what we do is help you sort of flesh out what you actually want to do and show you in real life with the numbers of, okay, if you do X, Y, Z, where does that sort of get you in 5 years? Or if you do A, B, C, where does that get you in 5 years, to sort of help with that clarity piece?
Yeah, it's I think that's what a lot of people need, is like a second opinion on because financial planning is like, it's not like you only have the finances to plan for life, right? And so some people are lost with both of those things completely. But getting some kind of rigor around the finances can help you design the life that you want, or help you readjust. And it's so important.
And then if I can put, probably on that as well, like 3 broader categories within those categories, it's typically the person that knows they need to do something but has no idea what to do. The person that's done heaps and heaps of research and is basically now in a form of analysis paralysis, so just can't make a move because they've got too much information. Or the third one is someone who's done a bunch of stuff and, like you said, wants a second opinion to effectively how they can make it more efficient. Like, have I done the right thing? That's sort of common as well. So almost those 3 types of situations come across the sort of 3 generalized client groups I described before as well.
Can I just off the top of my head, do you deal with many business owners?
So we do in terms of helping them. I guess where I kind of like to come in per se is we'll always give our 2 cents and 10 cents on tax structuring of the business and things like that, and optimization around those sorts of things. But generally, we won't provide any advice on how they run their business, okay? Because at the end of the day, it's like, if you're if you're a plumber, I don't really know how to be a plumber per se, so you should focus on doing that. I'll help you around the best way to sort of structure that possibly, along with, most importantly, I think I see for a lot of particularly small business owners is sucking out some of that money and putting it somewhere else as well. So diversifying it away from, say, just your home and then just your business. So then, because you said a lot of people go through life, small business owners, and they've got their, say that they might have their house, but then that plumbing business is all they've got as well. Now that may be a very good asset, but it's not very well diversified in case something happens in that business, they lose it. So we do a lot of education around, potentially taking some money out and putting it elsewhere into something that's, again, diversified, helps a sort of passive income stream. So they've got something else as well.
Yeah, I think any business owners that listen to this would be able to say, like, yeah, my business is either good or great or bad or somewhere in between. Yeah. But it's so important to build wealth outside of that. Have that, like, we've got a free business course, Alex, and in that I was like, it's really important before you set up your business to speak with an expert, whether it's an accountant or financial professional, whatever, just to think about like how you separate cash, how you separate ownership structures with you, your partner, your business, because, man, that is such an important thing for people's risk longer term, and getting advice is so important, probably from multiple sources, to be honest.
That's right. And then particularly, again, for like, if you're not an accountant and stuff like that, it's understanding, like, if it's in a company structure, like, what is company money, what is your money? Because a lot of people get confused and they just sort of go, but it's all my money, isn't it? Well, technically, no. Like that 100 grand you're referring to, it's actually the company's. Your money is the 10 grand in your personal account. So it's helping sort of explain how that sort of works as well.
For sure. I got one more question really before we get to the actual questions sent in by the community. And we have a big contingency of people that are interested in property, maybe not even necessarily property investors, but a lot of them are, to be honest, frankly. It surprises me. And people that are, like you said before, they're either trying to buy their first house, they're trying to settle down into a house, or they're maybe even upgrading, who knows. It's all like property-ish related. And we have a full channel for that, which we've created this year. But where does the line kind of get drawn in the sand around where the financial planner sits in helping people with that?
Yeah, so it's a good, really good question. And again, it's something that we deal with all the time, because like added to that as well is often, I want to buy my first investment property. How does that sort of work? So the line, to sort of summarize it quite quickly, gets sort of cut in terms of like, we can't tell you what specific property to buy. Okay, right. So we don't do that. I mean, again, I think potentially technically we could per se, because there's no real licensing around it, but our licensee doesn't allow us to do that, and most financial planning licensees won't allow you to do that. Okay, so you can't do that. What we do though, okay, is you might come to us and go, look, I want to buy my first investment property, but not quite sure necessarily on my borrowing capacity, and more worried about my cash flow as well, like in terms of the impact of that. So what we'll do is go, okay, great, Owen, what are some areas are you potentially thinking of? And you might be like, ABC. So we sort of look at the median price in those areas to make sure that firstly you can obviously afford it from a borrow capacity point of view, and then show you, I guess, the real life impact of, okay, if you did buy that, this is the the expected rent that we should be able to get, which we all pull from sort of RP data or Core Logic. So we use all that, so we have an accurate idea of exactly how much rent you should be able to get for, say, a 3x2 in that area, and then we can show you the impact on your cash flow. So you've got your salary coming in, which you obviously pay tax, and you've now got rent coming in, which you will now pay tax on as well. We'll put in there, the interest deductibility of that. We'll normally put some property expenses in there as well, so we've got that deductibility as well. So you should leave that sort of conversation or that session with a very good idea of, okay, I can actually afford it, and if I do buy it, this is effectively how it's going to look for me, which then obviously gives you the confidence to go and execute it, as opposed to you just go and buy something and then try and figure it out sort of in the back end.
Yeah, so you're basically sitting on like the personal side of that, like how does that asset impact your life?
That's right.
Not telling them to go and do it and say, go buy this property because it's a bargain on that street kind of thing. You're just sitting there and be like, here's all the information you need to make an informed decision. Go and speak to a professional. Go and, you figure that bit out.
Yeah, and that's where we'll often introduce the buyer's agent at the end, which is basically, okay, these are the areas they potentially want. This is sort of their spending power. You now know personally once they've executed, you'll be okay, and you can carry that cash flow wise. And often we'll include if interest rates go up by 2%, what does that look like? So we'll build in buffers so you can see that as well. And then, that's when you'll either go and do it yourself or obviously engage a buyer's agent to get that done for you.
Yeah,
Along
cool.
with, I guess, more general explaining to people the differences between land and houses versus units, and what yield is, and that sort of stuff as well.
For sure. So we have got, as promised, a bunch of questions that have been sent in. Please, Alex and I want to do these regularly, so please send in your questions. If you want to ask a financial planner a question, the place to do it is the thing that says "Ask a Question" in the show notes.
Makes sense.
In the podcast player, just click that. You can click any of the podcasts; it'll come through. But probably the Australian Finance Podcast or wherever you listen. So I was going to ask you about insurance inside or outside of super. I'm going to insert an extra disclaimer. I always do this at the beginning of the shows, but in particular for questions, is that we don't know personal circumstances. We just get the information through the question. So it's really important to know that we don't tailor these responses necessarily to the circumstances that you give us. Your needs, goals, or objectives are what need to be assessed by a financial planner as part of the financial planning process. So we can only give general financial information. So please consider speaking to a licensed professional before you act on the information. And if we do talk about things like ETFs, super funds, whatever, go get the PDS and product disclosure statement or TMD. Now, without further ado, I was going to ask you just generally about getting insurance, because we don't talk about it a lot on the show. And that's just generally because it can be a bit I think this is one area of people's lives where they need to get personalized advice if they want to do it, or at least do a whole heap of DD themselves and understand the difference. We can educate inside super, outside super. This is income protection. That's life insurance. But there were some great questions, and one in particular that stood out to me that came through, Alex, it's from a person called Traumatic Protection. So that's a good anonymized name. If I have income protection insurance inside of super and trauma insurance outside of super, can I claim on both policies if I experience an eligible condition that prevents me from working for a period of time? So they're basically saying if you have two insurance policies, inside, outside super, what's the deal?
Cool. So, really great question. So income protection, firstly, can be paid inside super or outside super. Okay, this person's obviously opted to pay for inside their super fund, which a lot of people do, whether they know it or not, because typically that's the default cover that you'll get when you open a fund. Trauma can't be paid inside super. That must be paid outside. So that's why, hence why in this case, they are paying for it outside super. Generally, you can claim on both. However, the thing to note here is trauma cover, which critical illness is a better way to explain it, because effectively it pays out if you suffer a critical illness like cancer, heart attack, or stroke. There's generally around 50 to 55 conditions which are in a trauma contract. I don't know why they call it trauma. Critical illness is a much better way to explain it. With our medical clients, sometimes when we start saying trauma, they think of trauma injury.
Yeah.
Again, that's not correct. Critical illness is the best way to explain it. It's actually not subject to whether you can work or not, however, as this person has sort of stated in the question. So trauma will pay out effectively if you are diagnosed with a critical illness and you meet the definitions in the PDS. So it's not subject to whether you can work or not. So you may say get breast cancer, and it's luckily they've got it very early and it's quite mild, so you're only going to have to go from full-time to part-time possibly. Okay, so obviously it's still impacting your work in that example. However, it would be paid out in theory at the point in time that it is diagnosed, whereas income protection is subject to your ability to whether you can work or not. So and the income protection covers you for an injury or illness. So take that breast cancer example, income protection could potentially pay on that as well. If that breast cancer is going to stop you from working for a period of time, income protection after the waiting period would then start paying you at that point in time.
We get a lot of people ask these types of questions, like if I have two different insurances, can I still claim on both? Yeah.
Yeah, so it's a good question. Again, the answer is it depends, to be honest. So, so with income protection, generally, pretty much in every income protection contract, they'll have an automatic offset clause of any other income protection contracts that you may hold. So, for example, again, real rough numbers here, say you earn 100 grand, generally you're allowed to sort of insure yourself for say 75% of that. Okay, so if you have an income protection contract, which is say covering you for 50% of that, and then another one that's covering you for 25, you would be able to claim on both in that example. But if you had two income protection contracts, both claiming you for 75%, okay, which is the max you can have, you wouldn't be able to claim on both in that example.
Okay, not to push this, because we're going to do a whole episode on this. We were talking before, we're going to do a whole episode on this. But a lot of people, like myself included, I kind of went above what was default in my super fund for income protection.
Yep.
Is it possible to get more than 75%?
It is, but it's not potentially possible to be paid out on that.
Yeah. And this is some of the things that people, I think, miss, if I'm being honest, Alex. It's like people think because they pay the insurance, they can claim for it. But then they miss things like medical underwriting, not being truthful in all of the details. And that's where getting specialists
over-insuring yourself possibly because you earn 100 grand, so you've just covered yourself for that without realizing that 75% might be the max that they do. That's pretty common as well. Yeah, there's a lot of, the way I sort of explain insurance to clients is like it starts off very broad, but then it does become incredibly bespoke or personal to your own situation. Quick example, like, say life insurance. If you've got an industry super fund and you haven't checked your insurance cover, you've probably got some life insurance kicking around in there. And you might be a single guy or gal with no dependents, no debts, no one that's going to sort of financially suffer if you're suddenly not here, as an example. So then again, you're potentially paying for some insurance cover that you don't really need at this point in time. That's another thing that we see, which is quite common. So you only ever want to pay for what you need. It's just making sure you've got that need correct. And therefore, you should basically, my 2 cents would be to review what you've got currently and a bit of your own situation.
I feel like if there's like two things in people's lives that are listening to this, it's not in retirement, so put them in a different basket, or like approaching retirement. If there's two things that people listen to this that they should do in their life, is one, review their super, and two, review their insurance. Because if you get your super right, it's a very big free kick in the long-term direction for compounding. And the second thing, if you get your insurance right, it's a massive, massive downside protection should the worst happen, and I just can't believe that so many people don't have their insurance. I think people just get overwhelmed with it, and that's where expert advice is so important. Okay, so we've got some more questions which we'll get to, mate, if that's okay with you. The first one, sure. I think I don't know about this question, so I've put a note in here. It's from Tracy. Tracy said, I have $10,000 to invest and need a broker. She goes on to tell us where she lives, exactly how old she is, how much money she has, what her financial situation is. She said, bad with money, bad divorce, no property, no savings. My adult kids will spend it all if I don't invest it. I need a broker. Please help. Now, Tracy, I'm going to be quite blunt with this response, and I'm going to say we simply do not know your personal circumstances. Now, and so I'm going to say we cannot answer this question, but I would say that if you are in a situation where you feel like you are struggling, the two best things to do is obviously to reach out to someone who you trust and get some help. Even if that's your GP, for example. The second thing is to reach out to a financial counselor. If you are struggling and you don't have the means, the money to go and pay a financial planner, go and get professional help from a financial counselor. You can Google financial counselor or call the National Debt Helpline and they can connect you. It is a free service and they won't tell you which broker to go with, but they will help you kind of get on top of the stress and anxiety of it all. And in the meantime, just keep listening to the podcast and hopefully we can be more general with the questions next time and help you out. But there's heaps of information on the Rask website. Just go and have a look. The second question now we might be able to respond to, Alex. This one comes from Bob. Mm-hmm. Bob says that he owns shares in two companies, Block, which is the owner of Afterpay and Square and all that sort of stuff, and a rare earths business called Linus. He says, should I declare these shareholdings in my tax return, even if I never receive dividends and don't have any annual tax statement? It is not even in the pre-fill section from the ATO website.
Yeah, it's a good question. But I mean, the short answer is no. If you haven't received any income or dividends from these companies, then effectively, there isn't anything to go into your tax return. It would be similar to, say, holding shares in maybe a private company or something like that, and they've decided to pay no dividends that year. Then there's effectively nothing to enter into your tax return. Upon obviously the sale of those shares, if you have made a capital gain or loss, then that needs to be entered into the return. But effectively, if you've received, I would obviously double check and make sure that is correct, and make sure you've got your tax file number lodged correctly with the broker and stuff like that as well. But effectively, if nothing has been received, then there is nothing to enter.
Yeah, I reckon Bob can be getting confused, Alex, between maybe this is Bob's first time investing in individual shares, and maybe he's used to like a ETF or a trust or like a managed fund or something like that, where they will send you a tax statement at the end of the year, because you may have tax occurring inside of that thing. Whereas with individual shares, one of the beauties of them is if you don't sell it, there's no capital gains tax bill. And if you don't receive dividends, there's no income. So that can be good and bad, of course. Yeah. But it's just important to keep on top of that as much as possible.
Did Block not pay a dividend?
I feel like it doesn't, because I feel like it's loss making. I should have checked this before, but I'm almost certain it wouldn't have, because it was in a deep hole after COVID, with no one spending, and their bad debts potentially spiraling after they've lent all the people money through Afterpay. So, right. And the Cash App doesn't charge in the United States. So, so Scrooge McDuck writes in, and this question is probably going to rear its head a few times. No pun intended with the duck, but best way to invest for your kids, Alex? Like, just generalized question, I guess, is someone's thinking, I've got some kids either on the way, or I've got, young kids, adult kids, whatever. A lot of people think about this. So what, in your dealings with clients, how do you tend to approach this?
Yeah, and look, it's a great question. And you and I were having a bit of a chat of it offline before we got going. And it's something that we get very regularly. As I said, a lot of our clients are thinking about having kids, or they've got young children and stuff like that. I think first and foremost, it comes back to making sure that your own financial situation and financial goals are effectively taken care of. So what I mean by that is, typically with new parents, not always, but they might almost feel like they should do something. So it's like, they're like, oh, I heard, John down the street's investing for his kids. Like, I need to do something for my kids, and get that going, which again is great. Obviously makes sense. You obviously love your kids, but it's first making sure that your own situation is sorted and tracking the way that you ultimately want it. Because at the end of the day, I guess what we explain to clients is, it's all going to go to the kids anyway. So there's no point, in my opinion, chucking in, $200 a month into a kids share account if that's going to be better off in your offset account right now, because you've got a decent mortgage, which again, most people do sort of in the accumulation phase. So it's first sort of thinking about that. Secondly, if, again, your own sort of situation is tracking pretty well and it's all sort of looking good from that point of view, it's again maybe linking it back to a goal. So I sort of mentioned to you before that a lot of our clients tend to like the idea, or at least the option, say, of private school, particularly in high school. So that's again potentially an area where you can start putting some funds away. If they're obviously very young, you can potentially invest some of that money to try to make the maximum return over that period between now and them being 12 years old and going to high school, to help pay for those future fees, which obviously again the debate on public or private can go on and on, but again, if ultimately you feel that a private education is going to give them a better leg up, that's obviously a way that you can do it.
And expensive,
that's right. So you start saving for it now, right? So that it's less of a hit to your cash flow when it comes around. And again, it's obviously giving you the option at that point in time. And what we'll do, again, sort of anecdotally, is often link it back to the private school or the couple of private schools that they're thinking. So we've got the actual fees, and we index the fees and stuff like that. So we, again, as much as possible, make it as realistic that when they get to that point in time, they've got enough money to fund that per se. Mm-hmm. And then so that's sort of those first two things. And then finally, if you do just want to invest, I guess, for your kids' future, it's potentially looking at, there's plenty of options out there with different brokerage accounts now, where you can effectively be the the trustee on it, and the kid can be the beneficiary. Generally, that means that you pay the tax throughout them sort of getting to, say, 18 per se. And again, hypothetically, though, at that point in time when they're 18, the ownership of the shares can be transferred over to them. It's a little bit grey, but then in theory, there's no CGT to pay at that point in time, which is a bit of an advantage that you can then obviously gift that shareholding or the ownership of those shares then to the beneficiary.
It's one of those things, like from your answer, what I'm getting at is like simple should be the default stance, whereas people tend to overcomplicate in the first instance, whereas simple means kind of like elegant but also effective for a lot of people, and it's less things to keep on top of. Like there's one thing about trying to like deflect tax in the present or the future, but there's another thing around just trying to sleep better at night. And I feel like a lot of people with an offset account right now will be saying, yeah, I just put my money in my offset and that's great, and I feel like I can get up in the morning and I don't have to check a portfolio, and I can, just be more present with my family, and it's simple.
That's
right. What I like.
Yeah. And you'll have less financial stress, which, like you said, that means that you can be then potentially a better parent. Other opportunities will come along the way that you'll be ready for, possibly too. So, and I guess like the final one as well is potentially you might decide to invest in experiences. So instead of putting that $5,000 a year into that share account, you might allocate that $5,000 so you can take a slightly better or more unique holiday every year with your children, possibly too. So you're giving them experiences that potentially maybe you didn't get yourself as well. That's another way that some people sometimes go with it too.
Yeah, like it. Okay, so we've got one final question before we wrap up today's first episode with you, mate. It's from Jason. I had purchased your ETF stock guides, which did mention a company called Core Lithium, which is a lithium company. I bought them and they have plummeted. But now I see in your report that you are not an expert on the stock, wondering why you suggested to your clients to buy the stock. I can tell you what, Jason, we did definitely not talk about this company. We may have spoken about it on a live show, but it's not the type of thing that we would ever invest in, and not on behalf of our community either. It may be an interesting lithium company, but definitely not something that is on my plate and nor on any of the team's plate. I've got a question for you, Alex, if I could turn this into a generalized question. Is I imagine you see a lot of clients come in and they have kind of like what I would call like a medley soup of different investments. Like they have some of this, maybe it's like a little bit in like a spaceship and like a couple of shares over here, maybe a couple of ETFs here and there. Do you tend to maybe not I'm not asking you for like what you would do in that circumstance, but as a general rule, do you tend to find that when you talk to clients about that, they tend to be like, well, I don't know, and then they just kind of clean it up themselves? Does that tend to be
it's a bit of both, to be honest. It kind of again comes down to what the client wants to do. Like a lot of the time, like you said, that's very common. Some people will come to us and they've got like $2,000 in spaceship and 1,000 in raise, and they've put $500 into 10 other either ETFs or direct stocks and stuff like that as well. So again, it sort of depends what the client wants to do. A lot of the time we'll simply just leave it per se, because it's normally not a huge amount of money. Some of it might have done all right, some of it might have done badly. So we tend to sometimes just leave that. Sometimes we do clean it up and effectively just sell it down. But a lot of it is then for us is coming back to like this real scattergun approach with only sort of small amounts of money, which is, again, what most people sort of have in the accumulation phase. To me, it doesn't really make a lot of sense. And that's sort of what we help sort of educate them on, that, look, maybe like a diversified core high growth ETF, if your plan is just for long-term wealth building, is going to make a lot more sense, a lot more simple, and get that sort of compounding effect going in there, as opposed to buying $500 of FMG and then $500 of CBA and or $500 of Core Lithium or something like that.
I would just say, it's very easy. I mean, if you're going to do that, you just got to keep it contained, don't you, when it comes to knowing your risk and those types of things. I feel like for younger people in particular, like anyone, I'd say under 60, when I say younger, I mean in financial terms, you've got so long to compound, even at 60. One thing I learned really early on, and I'm fortunate for that lesson, was that that's a long time. And so you should be focusing on the things that don't change. A lot of people come out swinging for the gates when they think about investing. I'll buy this thematic ETF, I'll buy that stock. The reality is, like 10 years, 20 years from now, will those things still be around? And more often than not, the answer is no. So just keep it simple and long-term focused.
And I've experienced that myself. When I first started out, I did the whole $500 of this, $500 of that, all those sorts of things. And some of them went really well, some of them went terribly, but overall, I can guarantee I did worse off had I just put it into a core ETF that tracked sort of the main sort of share market indexes and left it.
Simple works. That's kind of going to be one of the takeaways from this chat. So if people want to send in their questions, they can do that super easily. You can get in contact with us by hitting the thing that says ask a question. It's also available on all the Rask websites. It's in your podcast player on Spotify, Apple, wherever you're listening or watching this, or on YouTube. Keep in mind that there is also a link in the show notes to get in contact with Alex and the team at Everest. You can book in that first call for free. You put in your information. It sends an email to the team. You book in through Calendly. Presto, you can get on the road. And I feel like it's super affordable, mate, for people to get advice, which is the number one thing that I really want people to take away from this. If people want to follow you on socials, they can do that, right?
Yep. So we're on Instagram and Facebook. We're not on TikTok. Maybe one day.
That's good, mate. No, that's great. So there'll be a link in the show notes to those things as well. You'll be hearing more from Alex and the team at Everest over the next few months, and indeed into the new year. So please send in your questions. You can see he's got like a breadth of knowledge and depth as well. So send it in. Would love answering your questions. I'm going to leave everyone and you with one final question, Alex. Which is something I'm hoping to bring in, which is just like if someone had just 5 minutes right now, like they're listening to this, they get to the end of the episode, they're going to hear the ad that comes on at the end of the show, and they think, all right, I'm just going to keep going on with the rest of my day. Like, what would you tell them if you could take 5 minutes of their time and you could say, hey, do this right now? What would it be?
I think the main thing is sort of what you touched on before in relation to the super fund. So I would be checking if I have insurance cover in there, and how much it is it appropriate? And probably the other thing, again, linked to the super fund, is do I have a beneficiary nominated or not as well? So we see that a lot where people have got no beneficiary nominated, and a lot of the time as well, which again, we don't have time to get into it today as well, but they've nominated a beneficiary which is probably not eligible. Okay, so you can only nominate someone in your super fund who is what's called a tax dependent. Typically, a tax dependent is a spouse, kids, or someone you have an interdependent relationship with. So if you don't have anything like that, then you potentially need to nominate your estate. Your estate is then decided as per your will. So beneficiary in the super fund, check that, and then it may be worthwhile looking to see whether you need to get a will or not, which, to be honest, everybody does. So think about getting that sorted too.
Yeah, cool. There's like 3 in 1 there, so that's cool. So start off with log into your super fund. There's an app probably on your phone, or it's on the website. Log in using your member number. Figure out how much you're insured for. Check out that nomination of where your money would go in the event that the worst should happen, and go from there. We'll cover all that and more in future episodes. Mate, thanks for taking the time to join me on your first episode.
No worries. Thanks for having me.
Cheers, mate.